Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review with an emphasis on the HELOC. So if you've never heard of a HELOC, it stands for Home Equity Line of Credit. It's a very popular product. So what is it? What does it mean? That simply means that you could get kind of a huge credit card, aka a line of credit, almost a huge credit card, based on the value of your home and how much you owe on it. Okay, that's all a HELOC is. And so a lot of times people get this misconception like, hey, I've watched these other velocity banking videos and I can't do it unless I get a HELOC, right? Which is ridiculous because it just requires any type of line of credit. A HELOC is one specific line of credit. But first of all, let's define what a line of credit is. A line of credit is a financial tool where you could borrow money, pay it back, and use it over and over again. And if you just think about it, wait a minute, I have that. That's a credit card, right? Now, given that credit cards have some restrictions, we can still use credit cards for velocity banking. But just because you have a credit card doesn't mean you're doing velocity banking. Just because you have a home equity line of credit doesn't mean you're doing velocity banking. What's the difference between the average American and someone who does velocity banking? The main difference is what's your main operating account, right? And so if you take a look at this Reddit post right here, right, there's always people that write in once in a while about how they're struggling with their HELOCs and they can't figure out why. And so the way that velocity banking works is, in a nutshell, is that you're going to put all of your money into debt with the help of a line of credit. Okay? So, which means that you're actually not going to have any savings, right? Because you're putting all of your money into debt. And so after every single month, right? Every single month, that checking account or savings account balance should be zero. But every time I look at these, I'm struggling with HELOC posts, you'll notice if you just do a control F on the word savings, people want to keep their savings because that's what they've been brainwashed by society to do, right? Look at this question. Did you find a solution other than wiping out your savings to get the balance down, right, of the HELOC? So, I mean, again, we have to have a shift in mindset, compare what the average person is doing, and the average person has a very hard time of letting go of the habits that the traditional system was kind of, I don't want to say force fed, but was just presented. Okay, when we're in our formative years. Okay, so now let's go ahead and this is what I'm going to do. Before we get started, let me go ahead and read this with the AI generated voice. Okay, I actually put this in the AI generated, the voice generator. So let's go ahead and play this.
I took out a HELOC loan prior to the Fed interest rate hike in order to pay off debt and to increase our home's value with upgrades.
Actually, let me stop here. So, um, one of the things that you'll notice in the bank's marketing is that they always emphasize home upgrades. Now, why do they always emphasize home upgrades? It's because they want you to make big purchases um, that will eventually benefit them if they have to for some reason take your home, which they don't want to do, right? Like that's the last thing a bank wants to do. But the way, think about it, if you were a lender, the way that you make your money is through interest, and the way that you make interest is making sure that people carry balances and they don't pay them off quickly, right? So that's where the savings account comes in. Okay, so that's why every time you go to a bank's website about a HELOC, it's always like, why don't you just upgrade your home? And it's like 70, some people do things like spend $80,000 on home upgrades, which is ridiculous because that's like a full-blown renovation. But let's just keep going.
Our HELOC loan is now becoming unmanageable with these increases. Payment went from $300 a month to $700. We have excellent credit. The interest rate on house is only 3.25% / balance. $193K, so we chose not to do a cash out refi in order to preserve that rate. The HELOC rate is almost at 9% ADS rate now. We owe $87K. I feel stuck, stupid, and can't find a way out without cashing out everything we have in order to pay it down, since we don't have enough to pay it off. Is anyone going through anything similar? Did you find a solution other than wiping out your savings to get the balance down, so the payment is not as high since it's based on the balance owed? Is there any way to refi out of a HELOC? Because as of right now, I can't find any alternatives. If we refi our current mortgage, seems like we'll just be stuck with the high interest rate at a fixed level, considering this market.
Okay, so basically, you're kind of ignoring the only solution that would actually work, which is to wipe out your savings. But there's an easy way to wipe out your savings without losing control of your money. And I think that's the biggest fear that most people have. Okay, so velocity banking. All it is using your line of credit as your main operating account to wipe out debt. Okay, and two things. Number one is a budget. We have a budget right here. Number two, we need a line of credit as our main operating account. So we're just going to assume that we have access to a HELOC today, $30,000 balance. Maybe we'll say it's a $60,000 limit. Okay, and so we're going to do the velocity banking side of the budget. And when you're doing this budget, really important to list every single debt that you have, right? These are all your debts. And then this is your general expenses that you're always going to have to pay. You're always going to have to pay for food. You're always going to have to pay for gas, insurance, and all that. Okay. But debt, once it's wiped out, it increases your cash flow. So let's go ahead and copy this side to this side. And we're going to make a few adjustments. Okay. So instead of having savings, we're actually going to have zero savings. So what does that mean? After the end of every single month, okay, if you have a checking account, savings account statement, it should be zero or near close to zero. Okay, so that's essentially what that means. And then we're going to have something called cash flow. Okay, and you might be thinking, whoa, this just looks exactly like our savings. Right, but we need to do one more step, which is to make our line of credit as our main operating account. And so what do we do here? Okay, well, so what we're going to do is write down here our main operating account, which is going to be our HELOC. So we have currently a $30,000 balance on it, right? $30,000 balance. Now, if we have some available limit in our HELOC, we also want to shuffle some of our debt, right? So we see there's two credit cards, $13,000 here. So this is kind of like doing a credit card balance transfer. So let me just kind of add that. So one credit card is $8,000, one credit card is $5,000, right? And so that's $43,000. Now, because we're making our home equity line of credit as our main operating account, this is actually going to go to zero. This is very hard for most people to understand at the beginning, but that's because when we use it as our main operating account, we're putting our entire 5,000 into that line of credit as an overpayment. So if we put our entire 5,000, this payment really doesn't matter or affect us, okay? And then what we're going to do is we take our expenses out. Now, 800 is still kind of a little bit low cash flow, but because we move also these credit cards, right? Now these credit card payments go to zero. So we created about, I would say, $1,100 of cash flow on day one because we decided that we're going to get rid of our savings. Okay, you get that? Like, so this person right here is like, I don't want to wipe out my savings. I'm like, why would you not want to wipe out your savings? Because what we're going to do is we're going to apply our entire paycheck into that line of credit and take our expenses out. And instead of this itty bitty $200 of savings, I'm going to have $1,300 of cash flow. Okay, which one do you want? 260 or 1,300? Choice is up to you. Okay, so now what we're going to do is we're going to take the next month and calculate, we always make these calculations to take the next month's balance, which is you calculate by taking the previous month's balance plus the previous month's interest minus this cash flow number right here, 1300.9. And then after every single month, we get charged interest, but luckily the interest is only, even though people might be freaking out, 10%, and I could show you some of my screenshots of using a 10% line of credit. For example, one time I posted a screenshot on the community feed, on the YouTube community feed, where it's like I borrowed $127,000 and I literally only paid $1,000 of interest or $1,200 of interest in that entire period or that entire year. So that's like literally less than 1% interest rate, total interest paid, which is the number we care about, not just the interest rate. Okay, so let's go ahead and calculate the average daily balance, which is, we're going to do this right here, average daily balance, multiply by that interest rate, which is 0.1. And remember, we divide by 12 because the annual interest rate, APR, is 12 or is 10. Okay, but it's calculated monthly, therefore you divide by 12. Okay, and so now what we do is all we got to do is just copy and paste this. And so we're off to the races here of paying off our debt relatively quickly, or quicker than, we would have been if we're here, right? So let's go ahead and keep on going, and let's just keep going, and we're just gonna keep going and going, kind of like that Energizer Bunny. Yep. And so now, in a little bit over 3 years, so 39 months, we are debt free with the 2 credit cards and the HELOC. So it's pretty good, right? So 39 months, and then that's 43K of debt completely paid off. All right. So now this is what we're going to do. What we're going to do is now focus on paying off the mortgage. And you might be like, well, why not focus on paying off the mortgage first? Well, um, the difference between the mortgage and these credit cards and even the home equity line of credit is that they suck up more cash flow. Okay, just from a pure cash flow perspective, even though cash flow is tied to somewhat with the interest rate, although not like not exactly, right? There's other factors, but we can see here that for this $200,000, I only have to make a $1,200 payment. Okay, $200,000 for 1,200, or would I pay? All right. How much was this in total? Let me actually sum it up. So this is gonna be like B8 plus B9 plus B10. Okay, so would I want to only pay? Well, I don't want to say only. Uh, 13. So 43,000. I could pay 43,000 to get about $1,000 of cash flow back, or I could focus all my effort and energy into the $200,000 and only get $1,200 back. Which sounds better? For, like, if you give somebody 43,000, they give you $1,000 back a month, or you pay them $200,000 and they only give you $1,200 a month, right? And most people aren't that patient where they can wait 30 years and to get the monthly payment so that the bank accrues the interest. But so my point is this, is that we focus on these first because you recover the cash flow much more easier based on the ratio of the debt balance compared to the minimum monthly payment. Okay, now what we're going to do is focus on the mortgage. So first of all, let's do this. Let's go to our loan calculator to figure out, after 39 months, what is the balance of the loan. All right, here we go. So we have our loan calculator here. So if you ever dealt with like financial calculators, there's I think one called the HP2B or something like that. They ask you for like 5 buckets or 5 variables. And so if you have like 3 variables, you could figure out the payment amount. So for example, original balance, interest rate, the loan term, it'll auto calculate the payment amount. And then once you know these four, you could figure out like what they call the future value. Like you see this FV right here. I actually learned this from taking a class called Seller Finance Notes. Look up Jeff Armstrong, Seller Finance Notes, and this is where I learned about all of this. It's pretty cool stuff. But anyways, so let's go ahead and I'm going to do this 200,000 6%, right? 200,000 6% at 39 months. So what is the current balance? 39, right? And so we only paid off, and actually let's just do this. How much did we pay off? It's 200K minus 191, about 9K of debt after 3 years. That is pathetic. That is pathetic, right? So like I can't even explain it. It's crazy, right? But we only paid off 9K of debt. Now, let's just do this, okay? Why don't we move 9K of the mortgage into that line of credit? Basically, we dump, right? nine. Actually, let me do this. So let me go here, and then I'm just going to add $9,000, and we'll see how long it takes for us to pay off that 9,000. So this is about 39. It's about 7 months. So it took us about 7 months to pay off 9,000. All right, but it it took us, all right, 39 months. So all right, it took us 9 months to pay off 9,000, but according to this, when we're doing it the way that the bank wants us to, it took us 39 months to pay off that 9K, right? So this is kind of like, all right, how do I explain this? Now, a lot of people get really caught up in this, but one of the reasons why we use a line of credit to help pay off the mortgage, and again, we don't want to pay out like transfer the mortgage into the line of credit, is that we don't want to segregate our income. Okay? We don't want to segregate our income. And like I said, if you decide that you're going to get a first lien HELOC and then move it into I'm sorry, move your mortgage that's 6% and move it into 10% first lien HELOC, listen, you don't get enough cash flow to offset the interest. In fact, if you do what we call the chunking method or chopping up your loan into pieces, which I'll demonstrate with the calculator, okay, we got this cool velocity banking calculator, then you'll save um, a lot more money than doing a first lien HELOC, right? So let me go ahead and open it up. Oh, by the way, before I open up the velocity banking calculator, I just wanted to flex this, right? This is a screenshot from my cell phone. So, some people think it's like impossible to get huge lines of credit. Well, I paid off my house under 3 years, and then I got a first lien home equity line of credit for $280,000. So it is possible. You just have to brainwash yourself, and that's a term I'm going to use a lot from now on, over and over again, that you can do this just as long as you understand the basic principles and foundations of the concept, right, of velocity banking. So, yeah, let me go ahead and open that velocity banking calculator now. Okay, cool. So here's a velocity banking calculator where all you got to do is fill in the numbers here, and then it'll actually spit out when your debt is going to be paid off. So we actually don't have that much cash flow because it's $5,000 of income, 2,500 of expenses, and we still have this mortgage, right? So we see that we have about $51,000 of interest that we pay compared to the 142,000, but it's still paid off in 8.1 years. Now, let's say that we decided that we're going to put our entire mortgage into the line of credit. So it's 191,449.78, right? Let's go ahead and do that. We see that the tables are turned, right? So we only save about 75 grand by switching this mortgage into a line of credit. And this actually removes the payment if you look at like the behind the scenes calculations from this calculator right here. But this is a lot to handle, so I'm not going to go over it too much. But if you take a look here, if we replace our mortgage with the line of credit, it takes us 10.3 years and 75K of interest saved, right? All right. And then so now let me just do 5,000. Okay. So we just do a small chunk amount and we pay it in 8.1 years, and we save, actually let's do saved, 142K of interest saved, right? And so I don't know why people on the internet promote a first lien HELOCs, because it's totally not necessary. You could just get a second lien HELOC to do velocity banking, because again, uh, all you need the line of credit for, whether it's your credit cards, whether it's your personal line of credit or home equity line of credit, you need it to make as your main operating account. And the thing that I always like to emphasize is that let's say we even had a 30% credit card, okay? A 30% credit card. Look how much interest we pay, or we'll say save. 8.4 years and 134 grand with a 30% credit card. But, okay, but let's go back to a 10% home. Actually, I don't even need to go back to 10% home equity line of credit because we see that the 30% actually beats the 10%. And I know people are so focused on these interest rates, but they don't understand the nuances about it, right? Um, would I want the lowest interest rate ever? Absolutely. Like, I don't want to use a 30% credit card to do velocity banking. But even if I had a 30% credit card and that was like my only option, well, use the 30% credit card to do a couple of chunks. You know, the credit bureaus or the credit card companies are saying, wow, this guy actually uses the credit card a lot, or gal, no discrimination here, but uses the credit card a lot. And when you use the credit card a lot, let's say you do five, $10,000 chunks, you know, it's much more easier to ask for credit limit increases, right? Because you're using it, so it's much more easier to justify the credit limit increase. And listen, you know, 58 to whatever we did, or 134 to 142 saved, you know, that's not a really big difference in you know, like the whole, if you look at the overall picture. But 75 and 134, that's a huge gap, right? That's a Tesla that I probably could have bought, but I decided that I'm going to get a first lien HELOC. It's very important to understand these little nuances, okay? So let me just kind of go back here. So yeah, so let me just write down how long it's going to take. So it's 8.1 years to pay this off. So this is going to go to zero, right? So it's 39 divided by 12 plus 8.1. So that's 11.35 years debt free, right? And so how much debt was that? So that's, it'll be, let's see, 43. So that's actually 243K of debt. Let's see, 243K of debt. All right. So, right, and that's pretty much it. So again, how do we get from here to here? Well, it's basically wiping out our savings with the help of a line of credit, and then our line of credit essentially acts as our emergency fund in case we need more instead of our savings account. Because if we have money in our savings account, that's money that's being used to that's not being actively applied to debt. Okay. So that's really the goal of today's, or emphasis on today's velocity banking session. So, you know, just for fun, go to these Reddit posts, type in reddit.com HELOC or struggling problem or whatever, some keywords that would indicate some sort of issue with the HELOC, and then you could easily find posts like these, right? So, yeah. So here's what I'm going to do. At the end of this video, I'm just going to stare at this for a couple more seconds just so I can flex. And who knows, some of you might have a huge HELOC that are bigger than this because sometimes home equity is just based on where you live, right? Like if I bought a house in California in 2000, like it doesn't even matter, or Southern California in 2000 and maybe like Orange County, it literally doesn't even matter where I live. Like I could have still not chipped off my debt, but my property value could have gone to like 700,000 to like 1.2 million or 1.4 million or even 2 million in an instant, and I just have like huge equity out of nowhere, right? Because equity is based on your property value, which is based on something called comparable sales, right? Like how do you know what a property's worth? Well, it's what the next door person was, or what the house next door for was sold, and maybe two more houses along with it. That's how you kind of estimate the property value, because what's the value of anything? It's what a buyer's willing to buy it for and a seller's willing to sell it for. They got that equilibrium price that they talk about in your economics class, right? So, you know, if you live in a low property area, you probably won't get a huge home equity line of credit. And that actually corresponds with something that people don't really think about, which is that you need income to get debt. You need income. And a lot of people don't like to hear that banks don't lend money to people who need it, right? So like, you know, if you're in this debt, I assume you have some income. And I get it, people get laid off and all that, and I sympathize with you. But in general, banks don't lend money to people who need it, okay? All right. Well, that's it for today. Yeah, have a happy Saturday. Have a great day, and